Arkwood Financial, LLC, Arkwood Benefits Consulting, and Arkwood HR. As you know, as collectively as Arkwood, we are independent companies of which we do not offer tax or legal advice, which is why we have our guest speakers like Dennis and Matt join us. We'd like to have them provide those details to you. But our overall goal of the town halls is really just to make sure that we can have an avenue to talk about information, help clarify it, and then also, just to provide some tools and resources for you to really help, navigate the waters for COVID and just, everything else that's going on in our lives right now. So with that, I think I will, any questions that come in? Certainly you can continue using the info@arkwood.com. That has been successful in the past. We do have a chat feature. So if you'd prefer to have the questions come through in a chat, certainly feel free because we do have that monitored as well. And so on to you, Matt. How are you today?
I am great. How are you doing, Pete?
I am doing well.
So
I'm doing well.
Well, that's good to hear. So for all of you that have been kind of tuning in over our past sessions, you will clearly understand that neither Pete nor I will ever be gamblers because we were sure that by now we would have some sort of CARES 4 Act passed, and that has not happened. I will also say that what we're going to talk about today is going to kind of venture into a lot of gray areas. There's a lot of uncertainty still, so keep that in mind. And Pete, you kind of started to say what we've been talking about, things that are stressing us and keeping us up at night. Well, the gray areas also extends to our hair because of what's been going on over a month or so. So.
Not only are we getting the COVID-19, but we're also losing our hair in the meantime. Is that what you're saying?
Yeah, and some of us don't have a lot to go, so we hopefully get something passed soon. So yeah, I'm in the same boat, my friend. So I love Pete's title on this, CARES-ish. And we'll get into kind of what's going on with the CARES 4.0, but I really wanted to jump into just a quick review and really a review of what we thought was going to happen, but then also some of the takeaways that I think we all need to be aware of as business owners. And if they don't get fixed, then it's going to be, I think a big challenge for a significant number of organizations out there. This is a slide that basically we copied from a couple of weeks ago. This is what we thought was going to happen based on a lot of our well-placed informants, really just kind of reading the news and staying in tune with what's happening. But the PPP forgiveness, there's been all kinds of talk about having an automated or an automatic forgiveness feature of any loan $150,000 or under. And as you can see that represents a significant amount of the PPP loans out there, about 86% of all loans issued. Why that is going to be a challenge if that does not happen is banks and the SBA are going to be significantly overtaxed, if you will, when trying to process your loan forgiveness application if you're over $150,000, because they'll be busy with all these others. So we are still hopeful that is going to happen in some way, shape, or form. One thing that needs to get ironed out, and I'll put it in with forgiveness as well, is when you look at the PPP forgiveness form, there's a safe harbor feature, safe harbor number 2 specifically as it relates to FTE, and it states that you have to. I won't go through all the detailed calculations, but one of the very last tests is what are your FTEs on the date of your forgiveness application? Well, it has to be higher than the measurement period in previous periods. Again, I don't want to get into the details on that, but what I am getting at is the longer that banks don't accept forgiveness applications and that the SBA keeps punting down the road, the longer companies have to maintain a certain FTE level and still be able to qualify for that Safe Harbor Act, which qualifying for the Safe Harbor is a really, really good way to go. So you want to really try and do everything you can to qualify for that Safe Harbor. But they're making it incredibly hard by pushing this thing down the road. The only other thing,
Matt, that FTE forgiveness, I mean, because that's specifically relating back to the direct percentage drop if you are employing less employees than you actually were pre-COVID.
Exactly. Right. If you drop 10% in FTEs, you get 10% of your loan is not forgiven. It is a percentage that is applied to your loan amount, your original loan amount, and that will be non-forgiven. So, and some companies are looking to reduce FTEs for valid reasons, but by this fact of it being stretched out there, they really can't if they want to have a full forgiveness application. So.
Right, and then just to confirm is that it's not the same employee. It's a belly button. It doesn't have to be the same belly button. And then, all right, and then yeah, that came out weird, so I apologize for that. But then there's also, if you do terminate somebody for cause, that does not hurt your ratios. Is that correct?
That is correct, and you have to document that pretty well. There are some rules around what you have to do to document, as well as if you couldn't hire people, even though you're trying, you have to prove certain things. And again, I won't get all the details, but there are some steps you have to go through. But in essence, you are correct. If you fire someone for termination, or fire someone for cause, if you can't rehire when you're trying to, then those would be taken out of that equation, if you will. Correct.
Okay. Yep. Thank you.
Yep. This is probably the one that's even keeping me up more at night than even the other one, but the non-deductibility of expenses used for the forgiveness calculation. And I'll just give you an example. If there's a $1 million PPP loan, and you support that PPP loan forgiveness application with that $1 million of expense, you no longer get to deduct the $1 million of expenses for tax purposes. So in essence, what you're going to do is you're going to take that $1 million of your PPP loan, you're going to multiply it by your tax rate. And so in this case, let's use 40%. That means you're going to have a nice $400,000 tax bill come due next April, or whatever they decide tax day is next year. But that is a really, really important one. And I will tell you the AICPA is lobbying this one heavily. This one, ironically, is in the House bill, but not in the Senate bill, although we expect that to change. And we are hopeful that will get into the final act. So that one, guys, is just, there are some things that you can do. It might be a little bit too early, but I think you need to start thinking about it. But there are some things that you can do as a business to start creating other rapidly deductible expenses. There's certain capital asset acquisitions that are put into service. You could actually deduct either 50% or 100% of the cost of that. There are some tax credits that you can start looking into, but they need to get this one resolved fairly quickly, because we can't wait until December and then say, oh, guess what? They didn't get to the non-deductibility issue. So therefore, everything's going to be taxable. So this is really a ticking time bomb, and we're at the middle of August. This one's a big problem for tax planning purposes for all of our clients. So.
And I guess the only way that's not going to be as painful, and correct me if I'm wrong, but using your same $1 million PPP loan that came in, if my revenue dropped by the same $1 million, then effectively it's kind of a wash, correct? But if my revenue dropped only $500,000, then my pain is going to be on that extra $500,000. Is that a fair statement, or?
Yeah, that's a fair statement, because what my statement is, assuming all else is equal. Right. And I will tell you, I know there's certainly a lot of businesses that had a significant drop in revenues, so for sure. But I've talked to just as many where their revenues haven't dropped that much. In fact, I have one client that their revenues have increased over that time period. So they're kind of getting a double whammy. It's a good problem to have revenues increasing, but it's a really bad problem that you lose a significant amount of deductibility. So.
Right.
Yep.
Right. Okay. Thank you.
Yep.
And going on, negotiations continue.
So, so this one is interesting. As Pete alluded to, that the House adjourned until September 8th. I think we heard that on Friday. And then I think by Saturday, it was, oh, just kidding, we're not adjourned, and to basically come back. And I do believe it was related to the post office USPS issues. But the fact of the matter is they are in session. So if they're in session, then they can actually take actions. There are two bills out there. The Senate version still at about $1 trillion. House version, 3 trillion, give or take. I think there was a general offer that was thrown over the table from the House side, says, okay, we'll come down $1 trillion. And that was seen as a non-starter. One of the big things that I think is going to come into play here is, what is the economy actually doing? And, over the last couple of weeks, we've seen better job reports. We've seen more job postings. We have seen consumer spending fairly strong. We have seen corporate earnings pretty strong. You see what's going on in the stock market now. I didn't see today we were up and down and up. But generally the market has been very strong over the last several weeks. So, but why I bring that up is, if the economy seems to be going in a positive trend, then the need to issue a significant, it's hard for me to say significant is 1 trillion versus 3 trillion, but more significant stimulus of 3 trillion versus relatively moderate stimulus of 1 trillion. And I almost choke over my words saying those numbers, how big they are. Basically, if the economy is going well, then there's probably less appetite to do a bigger stimulus. So that's something to kind of keep your eye on with what's happening in the marketplace. So next one, Pete. So because of lack of progress in the negotiations, the president issued basically 4 orders. One of them was an executive order, and 3 of them were executive memos. Now, I never pretend to be a constitutional attorney, so Dennis, you're probably going to cringe if I say something like this, but my understanding is, yeah, go ahead, Pete. Yeah.
I was going to say, we had a slide from Dennis, so we have a little bit of a safety net.
Oh, perfect. So I'm just going to, so there you go. An order is written in the Federal Register and a memo is not. And so basically my understanding is that they all should be treated the same. It's just one is in the Federal Register and more part of federal records. So I won't say any more because I don't want to proven to be wrong in terms of the attorneys. So Dennis, do you want to?
Dennis, how do we do? Is there anything else you'd like to add on the difference? Because I just know that we've had that question: is why would they order? Or why would he do an executive order versus a memorandum? Why wouldn't he just make them all orders or all memorandums? And I've tried to kind of figure it out and try to explain it, and I think you've done a pretty good job by giving us a slide where it's the same really legal effect, but
Yeah, this slide is an opinion of legal counsel for the president in 2000, and it says they're basically substantively the same thing. So why they choose one over the other and have one published and one not, I'm really not certain. Essentially the authority of the president to make either an executive order or a memorandum, they're both presidential directives, depends on his whether the Constitution allows to do it or whether Congress has delegated authority to the executive branch to make certain decisions. And so it, whether it's published or not really has no great substantive effect.
We treat it the same, right? Yeah.
Mm-hmm.
All right.
All
cool.
Right. So with that,
I hope that helps everybody.
We'll say there's 4 orders out there, and we don't have to talk about executive order or memorandum, but 4 orders out there for our purposes. And one of them is really to attempt to provide additional assistance or extending the assistance to renters and homeowners to avoid foreclosure and evictions. It does not ban them directly, but it basically is a recommendation and suggestion and a request to the HHS secretary as well as the CDC director to basically stop measures to evict tenants. It's interesting that they point out there to basically help prevent the spread, further spread of COVID is really what they were stating in that one. And then there's no real dollars associated with this. And so the order also requests from Mnuchin and Dr. Carson basically to try and find federal funds available to provide temporary financial assistance to renters and homeowners. Now, what it doesn't say is, does that mean it goes to the landlords? Does it go to the individuals to then go pay the landlords? It doesn't really say. Again, these are requests. They are not, there's not a law or some sort of order behind it with some substance. It's a request to have them do this. Now, they do report up to him. So when your boss requests to do something, then you can take it, that way. That said, hey, this probably means you probably want to find a way not to evict people. So,
right.
Next one. So, boy, this one is full of all kinds of bugaboos. And we won't get into all the details, but this is a deferral of I'm going to call it FICA, which is just the 6.2% portion and the employee portion only from 10/1 through 12/31. This is not the Medicare portion, which is the 1.65% or 1.45%, whatever that percent is. This is simply the 6.2%. It's also on those earning $4,000 a week or less. So, I guess there's a question is, if you earn $4,050 in a week, in a pay period, I should say, it's $4,000 in a pay period, and it's bi-weekly. So $104,000, annualized a year, but it's calculated on bi-weekly pay period. So if you earn $4,050 bi-weekly, then you would be 100% excluded. That's the way I read what the order says. It's not up to the first 4,000 of earnings. It's anything, if you earn over 4,000, then you're 100% excluded. This has all kinds of, again, ramifications and questions that need to be asked. And we're really waiting for IRS and Treasury to give guidance as to how to do this. And really one of the biggest issues is how are payroll companies going to be able to deal with the changing of that particular withholding. And then the other thing is, if it does get withheld, it's a deferral. It is not a forgiveness. So are they, in fact, there you go, it comes in. So does that mean it's due right January 1st? You have 4 months of this payroll tax that needs to be coughed up by the individual? Do they wait until you file your tax return? I do know that the president has stated that if he's reelected, he is going to fight to have that total amount forgiven. But again, that remains to be seen. So, another question: if you earn 4,000, let's see if I can do the right math here. If you earn, 4,050 in one pay period, and then the next pay period you earn 3,000, well, in total you're under the 8,000. But so you not qualify for one pay period, but then do qualify for the next pay period. These are all nuances that need to be ironed out. And really what it's making for is a little bit of a headache. Well, let me say a lot of headache for employers and payroll companies.
Well, and I think in Section 4, if I'm reading this, where it says including legislation, I think that's the key. Because if I remember stuff correctly, and thank again, goodness, we've got Dennis on the phone, but they can't change, meaning President Trump doesn't have the ability of waiving it. They actually have to go to Congress to make a change or amend the Payroll Tax Act, right? I mean, that's in statute, isn't it?
It's fundamental that all revenue bills measures have to originate in the House of Representatives, not just Congress. So the Constitution states directly that raising funds through taxes have to come through Congress and specifies a means. Now, the implementation of a revenue building goes to the administration. So here, this is being interpreted that Congress has given authority for the administrative branch to interpret how to collect revenues, which is why it's currently simply a deferral. Now, if you wanted to contest this, you'd have to go to court, but there probably wouldn't be any plaintiff because nobody's harmed. Nobody would have standing in order to bring a case.
Right.
So this is just a great little exercise in our branches of government and how they work together. And Section 4 actually is as Peter says, is amusing, because the only avenue that the Secretary of Treasury could explore to eliminate the obligation to pay the taxes would be through legislation.
Mm-hmm. Yep.
So it's not, okay, I have some speculation, but I will withhold my comments for the future.
We always.
So it's not likely to happen.
We've been pretty good at speculation lately, Pete. So yeah.
I was gonna say. Yeah, thanks, guys. All for one for all, right?
Right, exactly.
I think you went through these. Actually, these are your questions you kind of talked through, so I was a little slow in the clicking, so I apologize for that. But I think you had answered most of these.
Yeah, I mean, I answered some of them. I didn't go through all of them. But again, what if someone gets a bonus and it puts them over the 4,000 just for that 1 week, right? So then what's going to happen? Do they automatically get kicked out? What if they switch jobs and kind of restart over and they have a lower, withholding amount or a lower salary amount at that point? It's really, there's just so much that needs to be clarified in this. And this one does need to be done fairly quickly, again, because payroll companies need to know what to do and how to basically enact this, because, withholdings, employee withholdings are actually, fairly flexible because systems are built that way. But this is actually a fairly hardwired percentage. It's been this percentage for an awful long time. And so they don't necessarily have this functionality built in to turn on and off that particular withholding very easily.
Right.
That's according to
it almost sounds like, it sounds like it was just a directive just to move the needle and get things done.
I think so. I think a lot of this was. So this one, we'll hit this one fairly quickly. This is the unemployment. It does affect Arizona directly. If you remember, unemployment was 600 a week, and that's what the House bill had in it, and then the Senate bill had $200 a week. One thing that's interesting to note is that according to a study from the National Bureau of Economic Research and the University of Chicago, 68% of unemployment recipients receiving that $600 a week were receiving more on unemployment than they were when they were working. So think about that in relation to getting people back to work. If they're getting paid, and Pete and I were doing some just quick calculations. If minimum wage in Arizona is $12.50, so I'm just rounding numbers, $25,000 annually, and then they're getting, they were getting $840 a week, so that rounds to roughly like 42 grand a week. A year, 42 grand a year versus 25 grand a year. So that is going to make employers hard, or make it hard for employers to get people back to work. So that was the push behind the Senate bill, is to lower it or do some sort of sliding scale. Well, the order that the president signed says, okay, we're going to give $400 in unemployment per week, but we're going to kick in, meaning we, the federal government, is going to kick in $300, and the state is going to kick in $100 of that, which Pete did some great research on that, and that basically complies with the Stafford Act, which that basically says that states can be reimbursed up to 75% of their costs. So if it's $400 in unemployment, the Stafford Act says we'll reimburse you up to 75%. So that's where the $300 comes in. Now, that $100 that the state would pay is optional, and Arizona Governor Ducey has already came out and said that we will take the $300, but we will not be kicking in the additional $100. So Arizona, it is $300. And again, the president needs to, in order to spend money, needs to have congressional action, except for certain things. And one of those things is FEMA dollars. And so right now, the way that this is structured, those dollars are going to come out of the FEMA fund, and basically up until the point that $25 billion remains in that fund. And Pete, you had some numbers on that, and you thought the number right now was like $68 billion or something along those lines. Is that in the neighborhood of 70 billion?
The July report says that there's $68 billion in the DRF right now, and that includes the first round of the coronavirus, the first round of CARES, but it doesn't include this, clearly.
So that's where the money is coming from, and that's how the justification is of not going to Congress to basically spend money. Just for references, Pete again did some great research on this. You look at the hurricanes, basically FEMA obligated about 12.7 billion, and then Katrina and Rita, that was about 19.6 billion in 2005. So these are big numbers, but nothing compared to the amount that there's available for this unemployment. So that one, there is funding available, but there's a big question is, can you use FEMA dollars to pay for unemployment? That would be the rub, and that would be where legal action can happen to basically prevent this from happening. So.
Right. And I think there was a part of that University of Chicago study, they thought that that this design would actually last about 6 weeks. So the December number wasn't necessarily a real number.
Got it.
I mean, December 6th, but the states are obligated out through December 27th. So it's so much ambiguity in all of this.
Yeah.
But let's move on to education, and I know that'll be quick because I want to bring up Paulo, but I think he had another obligation.
Oh no! Oh geez. Well, this was.
That's fine. I promised 15 minutes a section, and you and I have certainly exhausted that.
So this one is basically it's just an extension of what was in the original CARES Act. And it basically waives interest through the end of the year, defers principal payments through the end of the year, and then full payments to begin January 1st. What we don't know is, are your skipped payments all going to be due and payable all at once? I can't imagine that's a situation, but that needs to be clarified. So.
Right. Yeah, I know we had a conversation about that because I was learning of some mortgage deferrals where when they were going through that 3-month deferral action where the mortgage companies were offering help. And so we did some research with some clients, and we found out that at the end of the 3 months, they owed 4 months of the mortgage. So it really wasn't adding anything on. Like some mortgage companies were adding it on the end, so you actually kind of get that freedom of the 3 months. But clearly, these types of decisions can go either way, so we don't know which one it's going to be.
Right. Exactly. So I think that's about the end of it. So in the end, we haven't had obviously an awful lot to talk about, but really when you dive through it, it's like there's just not a lot of concreteness yet to this. And so stay tuned, and we certainly hope that we will hear a whole lot more clarification from Treasury, maybe some legislative action, hopefully. But it's really kind of a stay tuned, and a lot of these were just kind of be alert and know what's out there and what's coming down the pipeline should things happen or not happen that we've talked about. So.
Right. Thanks, Matt. I always appreciate having conversations with you.
Same here, Pete.